So let's see how we're going to go smoothly into our structure by starting to remind ourselves one more time that many traders who are successful on the market, they rely on a trading plan. As we gave many different so to speak, examples of what the trading plan means and why we're actually using it. It's just like a business plan. It outlines the establishment and develops a proposed business in details. The trading plan is the same thing. It's detailed structure for trading. Of course, we have to remind ourselves one more time that there are two major components of the trading plan. Within those, the rest of the minors, which, speaking of minors, that doesn't mean that they're less important. The two are a method of price prediction, or the so-called signals, if and when to buy or sell a particular instrument. And of course, the risk management program, which of course indicates the amount of money to risk on a trade and specifies when to cut losses. Trading plans, ladies and gentlemen, are fluid in the sense that they are being tested constantly and amended most of the time to improve overall performance and profitability. This is something that you always have to remember, because strict observance of the rules of the trading plan is the hallmark of a successful trader. Obviously, beginners should consider testing their own trading plan in a practice account prior to risking their actual money. While, of course, some company members might rush you in directly into trading if you are a trader, of course, I mean a beginner trader, of course that's not always the case. Even if you have a live account, it's better to have a demo account simultaneously altogether and test everything on your demo account before you risk it on your live account. Now let's have a look at the first a few points here that we'll take a look at first before we move strictly to the structure itself, the individual blocks that we'll also focus on. The first that comes to mind when we are speaking of general and the four major, of course, the four major points of a trading plan. This is the price prediction, the risk management, as we mentioned, the individual psychological state of mind, and of course, why is important to have a trading plan. This is an exclusive, just a question for you to answer very shortly, briefly, after we go through the first three. Profit, of course, on a trade is earned if you, let's say buy low an instrument and sell high. This is the ultimate explanation of what profit is. Well, of course, a simple concept. This requires the trader to have some idea of where prices will be, let's say, a couple of days from now or a couple of hours from now. So predicting the price movement involves different strategy, the one that you have considered to use on your own. However, individual strategy involves individual risk management system. This, of course, has helped many of you that stay here in the webinar today to connect those dots. I'm very grateful for all the questions and emails that you're sending as well. Thank you very much. To predict price movement requires a method A method that most traders tend to rely on some variations, let's say, of fundamental or technical analysis to predict that particular price movement. Many, of course, also spend considerable time and energy attempting to identify new measurements to signal, which, of course, sometimes they succeed. In most times, of course, failure is at hand. Let me remind you, different strategies are rarely made, let me say. Simply, they're just amended or fixed upon the shifting fundamentals as we move forward. Traders, of course, tend to begin with price prediction techniques or models which they are most comfortable with. This is by far the most simple way, and which pretty much all the basic or beginner traders start with. Those are intermediate or professional traders. They already have established their own system. That doesn't necessarily mean that they don't have to have a trading plan. If they don't have one, they can use our structure that we are presenting today to develop their own trading plan. Let's have a look at these price predictions. It is important that after every adjustment to that particular prediction model or a system that you have to accumulate, let's say, some kind of a feedback of your own system to assure you that it is effective of that particular change that you've made. So a backtesting would be necessary, or use a demo account to backtest it, or electronically over the MetaTrader 4. Personally, I prefer to test it for at least 6 months time to see if a system is actually working in order to present it. And those particular amendments that I'm making in the future, of course, they will also have to take a bit the same time to test them again if it is going to work. And the same time, I'm actually testing many of these strategies that I mentioned. However, there is no universal strategy that you can use. You have a handful of strategies that are working for every case scenario. So you basically use one for every case. Finally, we have to keep in mind that there is no guarantee that a particular system that has performed well in the past will continue to be an effective predictor in the future. Always have to remember that. So always have to doubt your system if it makes you unhappy with it, or it trades bad for you in a consistent time. Therefore, you have to see where it needs to be amended and test it along one more time so we can update it to the shifting fundamentals, as I mentioned. Moving forwards with the risk management, an integral part of every trading system, one of the major components, as we mentioned, of a trading plan. This means that it has to be established at thresholds to limit your loss in any individual future position, and to establish objectives at which profits on individual position will be taken as well. This is pretty much what risk management means. Now, there are different risk management systems. I'm not going to specify any. I suppose most of your guys that they've been here since the beginning of our webinars, even in our basic webinars, we gave you a few ideas, 5 to 10, 10 to 5, 10 to 10, 15 to 10 type of traders. If you remember, those are pretty simple, 5% of your equity, 10% of your equity, so on and so forth. There are different risk management systems that we have, of course, spoke about depending on our time frame and the system that we're using. So basically every system comes with its own risk management system, but there is one that actually can evaluate your system, whether it's actually sustained in the future. This is pretty much our most basic 5% risk. Relative size, of course, speaking of losses and gains, must be such that over time gains exceed losses. That's the ultimate rule. So that our trading and our efforts are profitable at the end. Now, this in turn depends, of course, always on the frequency of loss relative to the frequency of gain. Speaking of comparison between the two. So, for example, if we have to assume that a trader is using a certain trading system that is right half of the trading time and wrong half of the trading time, which is 50-50. However, when wrong, losses are limited, let's say, to $1,000 per trade, and when you're right, profits have to accumulate at least twice the difference. That's about $2,000 of profit before the trade is offset or closed. So this is one of the ways that you have to look at the reward risk ratio, 2-to-1 or 3-to-1. It really depends. Over time and after many trades, this trading program should be profitable at all positions, at all costs, or else you are actually going to wipe out your account, as most of the traders are actually suffering from such bad experience. The example that we just gave you illustrates a very simple risk management rule that you will, of course, find everywhere. That most of this simple trading risk management trading plan can incorporate 2-to-1 risk reward, or reward risk ratio, which is pretty much the one that I am using as well. Most of the times it really depends on the time frame. I might even just go 3-to-1 reward to risk. It's good to have it on, let's say, 4-hour or daily charts. It makes pretty good profits with this. However, you will need a trading system incorporated along with it, which gives you above 80% certainty trading signals. So something that is very risky, like scalping, for example, you will need to trade very heavily for small pips in size profit and 2-to-1 risk ratio, which is the most appropriate, which I incorporate on a daily basis. Determining the exact amount of loss that a trader should tolerate before a position is closed depends on several factors. Some of them we already mentioned. The amount risked on any position depends upon the amount of margin in your account. Now, this should be taken under account as well. Often it is suggested that no more than 10% of total margin should be risked on one position. However, the amount risked also depends upon the volatility of the instrument that is being traded. I've spoke about this in our volatility webinar, especially when I mentioned in volatile markets, like in about 10 minutes, we will see the CPI for US, a very important inflationary data. So I have all my charts open here. We can have a look at the some of the charts, or we can just remind ourselves about the news, what is actually happening on the market right now. I'm mostly eager to see what the euro dollar, to be honest, is going to do around this news, because it's set to fall today, and if it breaks below the 200 exponential moving average, speaking on 1 hour and 4 hour charts as well, 4 hour chart is more important at this stage. We might see 230 pips to the downside, which is a significant profit possibility. Speaking of risk management, the size of your average trading gain also determines to what level you should limit your losses. As we mentioned a couple of minutes ago, you need to limit your losses to a level such over time losses do not exceed gains in general. Just as with developing a good prediction model system, the parameters of risk management system should be evaluated over time and amended when appropriate. So, actual trading performance provides the trader with valuable feedback to perform such an analysis. So, having in mind that we might be able to double our account in 1 month, let's say. You're trading with $10,000. At the end of the first month, you have $20,000. Now, your risk management at the beginning was 10%, which is 1,000. At the end of the month, in the beginning of the next one, now your risk management is still 10%, but now it's 2,000. So everything goes in correspondence by profit and loss. So if you lost half of your account, then your 10%, let's say, would be $5,000. 500, I'm sorry, if you have been left with 5,000. Speaking of individual psychological state of mind, this is going to be a bit shorter because we've spared a whole section in our webinars speaking of the psychological side of the trading. Trading plans, of course, are very individualistic, let's say. They're based on such factors as personal experience, level which you are on the market at this stage, education, which involves risk that you can sustain of your capital, and tolerance towards that risk, which we say tolerance, that would say from a psychological state of mind. Some people are, let's say, more happy to see their profits erased by a trade instead of an actual profit. So you are getting very angry or very distressed or sad when a loss occurs, and then you jump to the other side, from a minus to a plus, cheering because you made a profit that actually erased your loss. But that's not the case. You should not look for this particular happiness. What you need to look for is how to suspend your psychological state of mind out of your trading when you're losing, because it's actually giving you a bad judgment on your next trade. And of course, you might even get your signals the wrong way, or even stop trusting them, or even miss a few points of your trading plan. Therefore, that brings us to the importance of that particular trading plan and why we need it. As we mentioned in the beginning, it's like a roadmap or a business plan that is getting you ready for the trading session. A good plan will of course be accompanied with the research you should have done before the trading itself. Now, those are the next points that we will talk about. You will see in the next page of the spreadsheet in front of you, sorry, the presentation in front of you, which we will cover all of the most important parts of the day during your trading. And I'm saying the day because we're focusing on the daily trading. Basically, the trading plan that we're making is for the majority of traders, which are day traders. Those are focusing on charts above day one, so on and so forth, which are mostly tending to the investor side of the business. Or in these cases, as I mentioned, ladies and gentlemen, trading plans are slightly different. Then the funds that are involved are a bit higher, especially speaking of risk tolerance. So if we're following our trading plan, it gives us a structure to manage our emotions by making sure that we are always focusing and always follow our approach. It ensures us that when things go wrong, we have a trading plan in place to bring us back on the track. Having something written down gives us a sense of accountability, as we know that we should be always strict to those rules that we set, and we're not making them up so we just go along. We're going to put those rules that we actually need. So from a psychological standpoint, everyone is individual. So let's say you are from the you're scared of making losses. The psychological section of this trading plan should be in accordance with different rules, like, let's say, having something in a value to remind us that being calm is more important at this stage, instead of losing control over our emotion, being afraid of that loss. Or being afraid to lose, that means we should be incorporating in our risk management system that we should trade with the absolute minimum that is allowed as a micro lot or a mini lot. It depends on the broker side. Now, speaking of GDM personally, this is 0.01. There might be other brokerage firms that provide you with a micro lot, which is 0.0005. Basically, it really depends on the person's ability to tolerate the risk and what makes him, let's say, uncomfortable when have to make the right decision. However, when we are flexible in our trading plan, ladies and gentlemen, it is still useful to have a structure in place upon which to gauge our way as we act along the way with the trading. To the structure, we need to add that there is a very basic trading plan structure, the one that you see here. There is pre-trade, there is the entry, take profit and stop loss along the way, what you have to do during the running of your trades, how to exit the market, and what you do after you exit the market. So it's not only the entry and the exit and what you do in the middle, but it's how you prepare and how you actually stay after the market itself. Now, there are things that you have to do even if you close all your positions. There is something that you have to do all the time. Let's put it a bit more differently. It's more like, how to say, I was going to say, like a prayer, but it might be something else. It might be your own ritual, let's say, depending on in the individual state of mind, belief, if you wish. So the first that we have to go through is the pre-trade. How do we prepare ourselves when we start to trade, when you start the market? Let's say there's a 1 hour or maybe even 2 hours. There are those that are getting up to trade much earlier. They brew a pot of coffee, let's say. They start with a nice breakfast. And personally, I would like to conduct to my trades on the pre-trade side of the trading plan is to evaluate what I've done so far. And there are questions that I'm asking myself as well. Very important questions which you might be also able to incorporate. Now, I have not listed them down here. You're seeing only the structure itself, which is a guideline. However, let me mention one more time that the session is recorded, so if you might need to review some of the details of today's session in the future, if those that are here for the first time and don't know how to do that, we have them uploaded in our YouTube channel. It's absolutely free for everyone. You can just review them one more time and see which of those questions you didn't manage to get. if those questions are in correspondence to your liking, or you see that it's okay for you, because the questions that I'm asking myself is pretty much what I don't want to miss from the market day. So the first question I'm asking myself is, what new has been released from a news point standpoint since my last session, or since yesterday? Let's say, okay, for those that are not in Europe, so we're going to just stick to day and night without saying any specific time frame or market. Let's say you're sleeping during the night, you're waking up, but during the night there are other markets that are working, so there are other releases that have different effects on the market, and of course will drive the market differently and might even confuse your point. So you have to go a few steps back to see what potential with that particular release that you see during the night will have over the market during the day. This is how you assess what is happening and what might happen. Of course, sometimes if you see some news, in most cases it's already done, let's say. So most moves rarely continue throughout the day. If I have to give an example with the European markets, during the Asian session, for example, before the European market opens, there is a lot of important things coming from Japan, from China, from other markets, if we're trading different currency crosses or exotics, that might affect our trading during the day, because there are no more releases from these particular countries. And the new releases during the day might take different route or even strengthen that particular direction from the previous release during the Asian session, like what we saw happened with the China, with its yuan. We saw what happened with the gold market during the night, during the Asian session. When I woke up and saw those moves, I had to read into the news what actually happened. So you see, this is how I'm starting my day. I'm questioning myself to see what I've missed while I was sleeping. The next question is, what scheduled data releases are planned during the time frame that you're trading? So basically, you might not always trade throughout the whole trading session. There might be some hours that you prefer to trade because you believe that between let's say 12 and 2 p.m. You will have the best volatility for your particular system. So you're opening your trading platform half an hour or an hour earlier, but then you just get caught up into some news releases, your signals get invalidated, you're making the wrong decision and you're losing money. So when you wake up, even if you're not trading, just have a look at the news, see the calendar, what is expected, follow that all the time to see how the market will react. And when the time comes, execute your trades. Also a very important question is my third question that I'm asking myself: what are the other correlated markets doing? So during one market open, during the Asian trading, there are a variety of markets that are working. Japan, China, Malaysia, Singapore, Indonesia, Australia, New Zealand. See, those are 7 different major markets, which we're not going to Korea or any other smaller markets out there that can actually affect what you're trading. And according to all that is my fourth question: what will be mostly traded during my trading day? So if I see in the calendar that I'm awaiting the CPI, that means less news for Europe, which means the euro dollar will be mostly affected after these releases. It's what we can see at this stage. The euro is pressing down, so even if I'm not seeing the news, I can guess that it's mixed to bullish for the dollar. All right, there is someone that is urging to say something. Let's give the mic to Luke. Go on, look. We're all in ears. Tell us what you think. I suppose you hear me, Luke, but if you don't have a microphone, it's very difficult for us to hear what you're saying. So either try the chat below to drop your question so I can read it out loud and answer to what you're asking, or just use a headset. So for now, I'm going to mute you. There's a bit of a noise on the backside, so we're not going to disturb everyone else. Meanwhile, if you just get a hold of a microphone, we're going to patch you through in front of everyone. So just let us know when you're ready. Okay, we're going forwards with our next point here. This is the entry. Speaking of entries, we mentioned that there are things that we have to do before entering. So this goes from pre-trade into entry altogether. So the pre-trade, you will get familiar yourself in what is going to be traded. According to the volatility that you're expecting, you will set your time frame, and of course you will choose the most perfect strategy that you're going to use with the risk management system. This is where all of these comes together: volatility, time frame, risk management, position sizing. These are all four topics that we went through all together by explaining you what they mean. And right now we're incorporating all of this into our entry, from where it comes to our take profit and stop loss from our risk management standpoint, position sizing, and a system that we're getting, because there are two ways here. If we don't have any announcements that are expected to bring a lot of volatility on the market, then we can keep our stop loss to 2:1 reward risk ratio. However, if we're expecting a lot of volatility, then we can bring our stop loss 2, 3, 4 times higher or lower away from our initial price, because volatility and price action moves can go straight through our stop losses even before our take profit is hit. So that is necessary to take your stop loss further away from your initial entry. That gives me a reminder here. So if you had any kind of short position from, let's say, below the level of 1.1 on the euro dollar as an example, which we have right now, and then your stop loss is 50 pips higher for 100 pips take profit, then in this case, most definitely, your stop loss has been hit in the price action just before the move that we're looking at right now on the charts on the euro dollar, as we're expecting the pair to decline further. Speaking of which, if you have actually brought your stop loss 3 times higher, that would go straight to a 300 pips of stop loss to a 100 pip of profit, and that's how you stay safe from that volatility price action. Let's have a look at the question that Luke is sending us here. So the question is, first of all, Luke is apologizing about the microphone. I understand, Luke, it's possible that you don't have it at this stage. However, you will have your chance in the future to say what you think live here in our webinar. The question is, how can you determine take profit, because there is times where it goes in untouched territory, so to speak. That's a brilliant question. Thank you for that, Luke. That brings us straight to our trading plan, how to find out which take profit to take. Well, speaking of, let's say right now, in euro-dollar terms, as we are already into this chart, we can see that there are several take profits that we can get. If our entry point is a few pips just below the $1.1 per euro, that means the next major support level comes at 1.097. That's about 30 pips down, or if you wish to take a bigger profit, that's 0.094, or even way down to 0.08. There is a variety of profits, but if there is nothing that you can clearly see on your time frame, that means you have to go to a larger scale time frame, go to a bigger time frame, see if there is any other major support or resistance levels that you can use as take profits. Or let's say the system that you might be using, for those that are using different systems that have, let's say, 20 pips take profit and 10 pips stop loss, this is a general rule that they get, so they don't really care how low or how high the price will go. They only care about those 20 pips that you're getting, and those are the so-called price fixed take profits, or pips fixed take profits, which are mostly used for scalpers that they're looking for about 10 to 20 pips of profit. When you take away the spread, which is usually below 1 pip, sometimes let's say 1.5 pip on the euro dollar, that leaves you with about 8 up to 9 pips of profit. If you're trading with 10 lots, that's $800 to $900 per trade, and if you're trading on 5 to 15 minute chart, you already made your paycheck if you're trading like this every day. So this is just an example. Look, there is a lot of other types of trading systems that people are incorporating in their trading plans. Me personally, I'm trying to stay into the 2-to-1 reward risk. So basically, I'm using my support and resistance levels to generate my take profits. And if I don't have that kind on the 4-hour chart, then I'm going to go to the daily chart, see if there is anything major, or just zoom out that particular 4-hour chart and see on the bigger picture what there is. I hope I managed to answer your question. If I haven't, or if you have any other questions, please, by all means, share it with us. Thank you for the question. That's all for the take profit and the stop loss levels. We can, of course, go back if there are any other questions without a problem. However, I want to move forward to what we're doing during our trading. So our trades are now opened. Another form of, let's say, useful confidence or self-appraisal that you should incorporate into your trading plan takes place during your trades. This will help you to keep your emotions and your decision-making on an even pace throughout your trading session. So there are traders, you know, as scalpers or swing traders or day traders. So there are those that are opening position in the beginning of the day and closing it at the end of the day with no matter what the profit or loss. So basically, there are time limited traders. There are those that are focused on the amount of money that they need to make at the end of the day, and there are those that are just after the bigger profit. So depending on the type of trader you are, you always have to have in mind that psychology, your emotions, are your worst enemy. During your trading, during your trades, during the running of those trades, fear or any other kind of emotion can actually, push you to cut your profits too early, or just to get scared that your losses are getting very close to your stop loss, and just tell yourself, oh, this is definitely going through my stop loss, so I'm just going to cut it here. But in the end, it doesn't even go there. Just a few pips away from it, but still it doesn't hit it. This is the time when you have to be absolutely calm and trust your trading system, trust your trading plan. If, of course, as we mentioned in the beginning, the trading plan is not working well, you have to reevaluate it or get someone to help you with that. If your trading system is not working and your stop loss is hit, and then in a few pips higher or lower, the price starts reversing down to your target, because this is also something that I've mostly seen in the market. This is badly calculated take profit and stop loss. I can assist you with that if you wish. This is accordance to your trading system. Everything is connected to your trading system and your risk management. Of course, in instance, if we were wrong in general about the decision that we've made, and we're considering exiting, let's say, when you ask yourself, if I was wrong and the price is not going higher but it's going lower, then wouldn't it be better if I shorted here, because I can see that the price right now is very high. So you know, I think my trading signal was wrong, but then my gut is telling me that the price will fall. And then you simultaneously open two positions, one up and one down, or just cut your long positions and open a short position, and eventually the price will go up to your target. This is something that actually happened very often to me in my early days of trading. I was in doubt of myself about my capabilities. Of course, they weren't so good as they are right now, but that was the first problem that came to mind. When I get up in the morning and I start trading, start informing myself of what the market is up to, when I go through all of the points of my trading plan, and I get to the point where I have to wait patiently for all of those profits to be taken, or eventually my stop loss to be hit, and admit that I was wrong, I started doubting my own systems, my own trading plan. In fact, it was actually brilliant, it was flawless, but then I was making the wrong decision because I was psychologically weak. I wasn't strong enough to withstand the pressure of the market. This is something that happens to most of the people. So an advice here, if you are waiting for your profit to be hit and it's about 100 pips big, let's say, it's very good to look at a larger time frame just as a convenience that, let's say, in a distance the price is not moving that much as well as it does on 15 and 30-minute chart. This is something that you can just, you know, just lie your brain that everything is fine. But along the way, your take profit and stop loss are there, and they're protecting you all the way. So all you can do by just observing larger time frames where fluctuations and volatility is much smaller in size, that's how you will actually train yourself to totally divorce yourself from any particular emotion that can actually push you to making a wrong decision during the trades that you're waiting to be completed. This is just, let's say, something like an example that I gave you, that it might happen. There are different cases. If you have any kind of psychological emotions that you're getting during the trading, please, if you wish, you can share it. I might be able to give you some good ideas. But right now, I'm not going to spend too much time on that. Instead, I will go straight for the exiting of the market. And I'm not speaking of exiting your positions, because you already done that with your take profit, but I'm speaking of the exit of the market itself, the conclusion of your trading day, how you decide that this particular trading day for you is over. And after that, of course, we will have a look at what you're doing after all of this has finished. First of all, there are some questions here that I'm also asking myself as a pre-trade. On the exiting the market is very important to evaluate how a trade went, or the trading day went, or all the positions, and why it actually went like that. For instance, some of the questions that I'm asking myself is, why did I enter this particular trade? So, was it my system that told me? Were they 3 indicators that were showing me, let's say, that the euro is falling right now, or plus 1 indicator that is showing me neutral, which is a pretty good signal, by the way, or just because there was a gut feeling that confirmation after I got 2 short position confirmations from 2 indicators. One was still neutral when one was long, and I was having a gut feeling that this which is neutral is actually going to signal me short, but instead I made a wrong decision. Or why did I actually enter that trade? What made me do that? Of course, it is the system, but what exactly in your system made you enter the market? How it is actually signaling you? Was it appropriate? Were all of the rules of this particular system kept? Because trading systems have their own rules, as we already know. Why my decisions are correct or not, or why not? Those are 3 questions in one. So there is why my decision was correct, or why my decision is not correct, or why my decision went wrong. Once in a trade, this was the during your trade's standpoint here. Once in the trade, did I control my whole emotions? This is another question. So you see, this is a re-evaluation of what you did this trading day. Was my entry level a good one? So you got a signal from your first question that we have, why did I enter that trade? Then was the entry a good one? Because if you're a manual trader, that means you might not be able to catch the best trade, like the best price, or you might need just to wait a bit to get a better price. So was all of that in control, and was your entry a good one? Then the next question would be, was your exit level a good one, or my exit level a good one? Another question that I'm asking myself, did I hold on too long or too short? So have I cut my losses, so have I cut my profits too short, or have I kept them too long for the price to reverse in a negative territory? Did I spot any indications as to moves or where they missed if your system failed somewhere? And why did it fail there? Maybe it needs adjustment. Maybe this was just a force majeure event, let's say. A CPI release like this one, to be instance. So, one of the final questions here, what could I have done better from technical, emotional, or fundamental standpoint? There are only 3 ways. What, of course, is the last one will I work on to ensure that I will learn from this trade to the next time? So how all of these questions that I have here, by answering them in on a piece of paper, will help me to get better next time, to keep my rules or improve my systems or improve my trading plan right away until the next trading session comes. Also, at the last thing, when we have all of this done, what do we do after? Or why did we actually exit the market so soon or too late, let's say? This is what we're doing in post-trade. Also evaluating the timing that we ended our trading day. An evaluation, of course, is very important in this sense. That is, of course, it provides us with a particular objective, ladies and gentlemen, a perspective on our trading performance. It gives us an opportunity to look back on what we have done just quickly as possible, not just by asking those questions on the exit the market, but quickly just overlook in your brain, in your head, what we have actually done so far. Did we do well? And what we need to improve. Just to remind this to yourself. Fair and honest, of course, appraisal is important, and you should not be too harsh on yourself, of course, but equally you should always also not be blind to things which should be, of course, improved, because this is your own money on the line here, ladies and gentlemen. You cannot just miss out things or just be blind to the fact that something went wrong and you are not ready or afraid to admit it to yourself, because this is what you're doing for yourself, by yourself. There is nobody there that is going to judge you worse than you do. But of course, at the same time, do not be too harsh to yourself. So and there are mistakes sometimes that happens, and there are those, of course, that must be avoided and could have been avoided. And those are the mistakes that we need to filter out with our trading plan. Of course, now for the last here on post trading, what I'm also doing as an example, I'm also evaluating the decision that I've made by exiting the market, let's say, a little bit earlier than usual. Let's say I have a plan in the morning to end my trading day, let's say in about 5 minutes. That would be half an hour before the US market opens. And why do I want to do that? Because probably the trading will be choppy. It will be a lot of spikes because of the execution and the positions that will come into US market. Probably because I'm too tired and I don't want to go, to undergo all of this, as I would like to keep my profits instead of just lose them on a heavy brain, you see. This is also something that I'm doing, because in about 5 minutes you will start seeing how the volatility will start rising on majors. Also, let's say I got up a bit too late, but I took time to advance into my trading plan. I didn't skip any points. So today I might want to even stay after, let's say, after UK market is closed, the European market as well. I will stay just a few hours later when the only market will be the US market that is controlling the markets in the prices. So I think I can do better, so I think I'll stay on, or I'll stay longer because I didn't achieve my goals today. Those are the things that you also have to ask yourself, and ask yourself whether you made the right decision. Because if you stayed too long and you were tired and you lost half of your profits that you've made, you're still on a daily profit, of course, but you could have avoided that by ending your trading day earlier. This is a common mistake, by the way, because for scalpers, this is a very, very heavy job. Staying on the market hours after hours, monitoring the small time frames, executing trade after trade, 20, 30 trades a day. This is exhausting. So these are also the questions that I might add to any trading plan. Well, this brings us to the end of our session today by giving you my thanks for attending our webinar today. We have seen how the structure is made, what is the general structure of every trading plan. From here on, you can actually start building on this. You might even want to add a few things, let's say on the stop loss, maybe you could put a few hours on the side, just decide that you have different plans of stopping your bad trades, or take profit. Let's say you have 2 more hours, arrows here, just telling you how, what many ways you have to exit the market, and just try to incorporate every different one for every case. But this is just the general structure that you need in order to develop your own trading plan. And of course, one of the most important things before we actually start on the live chart to see how exactly this thing is working, how the trading plan have to go on a live chart, we have to find out when to avoid the market. And this is what we're going to talk about this Friday. Same time, when to avoid the market, the topic of our next webinar. For now, thank you very much for joining us. I'll see you next time. I hope all of you will be here, and for all of the questions today, thank you very much. I'm more overwhelmed. I'll take a few hours now to answer all of these and get in contact with a few of you guys. As you can see that it's a bit more complicated. It needs time to be answered. Thank you very much for joining us. I'll see you next time. Bye-bye.